Stephen Daghlian joins us from CommSec. How do we begin the start of the end of the working week, Stephen?
Exactly right. A very good morning to you, Peter. Well, it looks like we're going to get off to a sluggish start. I mean, yesterday was the best day in a few weeks for our market. We're up about 1.5%, but today it looks like we're going to probably fall by about 1/3% or so in early trade. Now, this is the final day of the week, the month and the quarter as well. Over the week, we might be largely flat because of thanks to yesterday's improvements. The month is a different story, though. We're down about 6.2% in September. So depending what happens today, it's either going to be the second or the third worst month of the year. The quarter is a bit better. We're only down by about 1/5% over the last 3 months, but it does follow a 12% decline in the June quarter when concerns about inflation, rising interest rates, was also certainly at a peak. June was the month where we had that biggest rate hike in over 20 years, that 0.5% lift, which certainly rattled markets. But since then, that's continued to be the case. And we'll find out next week how big that rate hike is. But today, what has certainly been a bit of a negative and a headwind is the fact that the US markets have fallen back again, as did markets in Europe as well. So yesterday, we had some strong improvements thanks to those surprise moves by the Bank of England to step in there and try to calm bond markets for the next couple of weeks. But I think now the focus is back on the Federal Reserve, and a couple of officials there essentially just reiterating their plans to keep raising interest rates. No plans to slow that down. And it's probably not helped by inflation out of Germany as well, which was the worst in about 25 years in overnight trade. So that just solidifies the chances of another 75 basis point lift by the ECB, which is going to meet late next month.
Okay, Stephen Daghlian, thank you.